Welcome to the Salty Investors, episode number 43. It is Friday, 11th of August. How are you this Friday, Tim?
Yeah, pretty good yourself.
Oh, beautiful. It's absolutely superb outside. I'm going out to run around naked straight after this. I
Nice.
mean, that's just the kind of thing I'm into. But let's get into some salt this week. You may have noticed, Tim, that the Commonwealth Bank posted a full year profit of just over $10 billion for the financial year ended 2023, which sent the financial illiterates into a meltdown. How could they do this? So many are suffering under the weight of higher interest rates, which they signed up for. We should impose a super profits tax. Now, I just want to impart a little history here. In 2017, CBA made a profit of $9.9 billion. So if you inflation adjust the most recent profit number, they actually made more money in 2017. And in fact, in 2010, CBA crossed the $5 billion mark for the first time. So if you inflation adjust their profits from today to 2010 numbers, CBA's profits have basically flatlined for more than a decade. And even worse, the share price is only up 80% in the last 15 years. And, you know, when you use the basic rule of seven, suggests their stock price should have at least tripled. Now, of course, CBA investors have been reaping fully franked dividends, and that keeps them happy because they're also financially illiterate, but that's a story for another time. So basically, the resent-filled morons calling for super profits taxes generally know as much about history as they do finance, which is to say nothing. And as far as I can tell, they just decided, $10 billion is a big round number. We should complain about that.
Well, I'm actually salty about the same thing, as you can probably guess.
Oh,
But
really?
yeah. But you've seen the ABC; they're jumping on board and they're having a go at it as well, and they're calling it $10 million. And I thought I'd look it up, and currently their return on equity is about 14%, but historically it's been about 10%. So this isn't a great business, and they've got debt of about 160 billion. And if you look at their free cash flow for the last 12 months, it's about 7.6 billion. So you put that on a capital return, it's about 4.75%.
Yeah.
And I tell people all the time, like, if you put your money in a term deposit and get 5% with zero risk and zero effort, would you run a complex bank and earn 4.75% in the good years? What about the bad years? And I haven't found anybody who's taken up that offer yet. So I don't know what people are complaining about.
I know. Yeah. Let's add to that it's probably the most regulated industry in the country, and maybe if we had more competition in the banking sector, maybe people would be able to get a 30-year fixed mortgage and wouldn't have to complain about rising interest rates because they could have locked that in. But hey, you want the four pillars system with a couple of regionals floating around and some credit unions here and there, and well, that's the system that you got. CBA's profits aren't ridiculous. I mean, it's always the idiots that weigh in on this stuff. Like, I don't know. It's just one of those things you got to roll your eyes at. I think it's because it's the sentiment. It's the time we're in where people are actually doing it tough for the first time in 30 years, and so we just got to complain anywhere, harness the resentment of people that are doing it tough and aim it at big corporations.
Yeah, grievance and resentment, great fuels for,
It's a hell of a drug.
Yep, like you keep saying, and seems to be a great time for it at the moment. And I just say, just terrible way that people sort of think. Yeah, but it's the ABC as well. Like, that's government funded, and they're fueling this fire of, the banks have got all this money and you're finding it a bit tough. Where was the ABC saying, in COVID, we're going to spend all this money, drive up inflation, force the RBA to lift rates to fight it? They forget the first piece. What caused the RBA to freaking lift,
What the ABC and leftists generally hate is they hate when people get to keep the money that they earned, but they absolutely love spending other people's money. They love that, but they just don't like when people get to keep the money that they earn, or corporations for this.
Yeah. Well, invest in CBA if you love it. You think it's making tons of money if you want, but
yeah, it's not actually a good investment. I mean, like, look at that. The share price was $61
Yeah.
in 2007, right? And it's now 104. I mean, yeah, the rule of seven, for those that don't know, is, basically you should be compounding your money, doubling your money every 7 years. And they haven't doubled their money in 15. So and like I said, they're paying dividends probably at average yield of about 4% or something like that over that time. But still, it's still not a good investment, even when you add that up.
And you pay tax on that. When you get that dividend, if you're in the, paying above 30%, you're getting. I know you got the franking credits there to help you out, but if it wasn't for franking credits, like they want to get rid of that too. Yeah. So,
well, it has fooled an entire generation of investors that that are aging out at the moment. But this idea that, yes, because I'm getting a 4% dividend yield, it's wonderful. It's not really. It's all about return on capital, and if you can find a company that can compound, its return on capital at plus 20%, then you're better off doing that and getting share price appreciation rather than dividends. But you can't talk people out of what they think is a good deal.
Welcome to Australia.
Yep. Moving on, latest inflation number out of the US that came out last night, I think. So, headline number turning up. Now, we said this, didn't we say this last week or the week before? I was saying, just because of the way the seasonality works out, you've got certain numbers dropping in and new numbers dropping in and others dropping out, that you should expect to see this go up again. The core number was basically flat. I think it was down 0.1 or something. So it's still at 4.7. So people are saying, it was funny seeing the commentary online. People saying, oh, this means the Fed they can't stand still. They're going to have to raise again. And then you've got people saying the complete opposite thing. Oh, the Fed doesn't need to raise now. I don't think people know. But yeah, I think, again, just the old theme is that it's going to stay higher for longer. Don't expect this just to keep falling, through the floor. It's not. It's not going to happen. I don't know if anybody's seen oil and gas prices lately. Did you fill up your car this week? Because it cost me 20 cents a litre more for petrol this week. And that's after hunting out the lowest price I could possibly find. So
it's not looking good on that fuel and energy. Electricity prices are still insane as well. So can't see it diving too quickly, but it will dive. But I see people again go, oh, why have they got this band of 2 to 3%? Why can't it be 4 to 5%? Like,
oh, it can be. It can be.
And then we can stop. Then we'll be fine. But you can't stop. They can't control it like as closely as people think. It's lags, and it only affects certain parts of the economy, and
and they do, and fair play to the Fed, has recognised mistakes of the past. Notably the 70s, when they thought they got their hands around inflation a couple of times, only for it to run away again. So they are cognizant of that. I think the RBA is as well. But the idea that they can perfectly calibrate this is, you have to be historically ignorant to think that they can do it. So they're either going to undershoot or overshoot. It doesn't, one way or the other. And nobody will be happy. Doesn't matter usually. Or some people will be happy, but there'll be a lot of people that won't be. There's not much they can do about that. So just inflation genie is not going to be put back in the bottle just yet, I don't think. Moving on. This was interesting. I think I've ignored this for a while, because I don't believe in the China recovery. I don't not believe that they're going to recover from COVID lows, but I think the China story of the last 30 years, where they grow consistently at 6% plus GDP, I think that is over. And I mean over for good. I think this is their demographics are basic. It depends who you listen to. Some people actually think that China's population is going backwards as of now. Some people think it'll be 2030, because it's all, what they're like with their data. Who knows, really? And I just think that get used to this stuff. It's not like they're going to become Japan.
But
Yeah, they're just not going to grow like they used to. They're still a big economy. They're still, transforming their economy. They're
Hmm.
opening up coal fire plants left, right, and center, and nuclear plants and all kinds of things. But yeah, this shouldn't be surprising that their imports and exports are falling. So yeah, I think we might be. I mean, I'm quite happy to be proven completely wrong. There seems to be a consensus now: no recession, soft landing,
Yep.
maybe no recession at all, not one this year, maybe not even one next year, smooth sailing. And I think maybe this is just another sort of nail in the coffin of the no recession camp. But I think I'm in the minority right now on this sort of thing.
Mm,
But
yeah, yeah. But I like China slowing down. I don't like it running
yeah,
so hot. These 7 and 8 numbers. Like that's just
yeah,
insane for such a large economy. I like a
yeah,
3 or a 4 number. I'd like an
three
honest
or
3 or 4 number.
yeah, yeah.
Percent like GDP
Look,
growth. What
growing
does
three to
US do?
four
2?
percent.
Yeah. What is
Yeah, I mean,
one, two? So
growing 3 to 4% puts you in the top,
yeah,
10% of economies in the world.
yeah. There's
Um,
nothing to be ashamed about that. And you're not going to run as hot in certain areas. To run at 8,
yeah,
there's got to be certain pockets that are running, 15. Like you can't. It's
yeah,
not even across the board. So to have generally running at 7 or 8 means you got to have really hot pockets. So I think
yeah. Apartment buildings that nobody lives in, for
yes, yes,
example.
yes. Yeah. Building roads to nowhere or whatever, dumbass
Mm.
centralized project you can come up with. But yeah, I'd like a little bit more, stability in China. And I think that'd be good for Australia as well. Instead of having these boom and busts, we'll have a little bit more stability. In the iron ore price, it'd be good for BHP, it'd be good for Rio. Um, but yeah, I don't know. Is it really in a downturn and it's going to continue going down below, you know, 3%, 4%? I don't know. Yes,
I
I think so.
I
But
think
I'll
it will.
look 10 years. I think 5 to 10 years that's going to take to go, to a 2 or, 2% GDP growth. But yeah, a little bit different there.
Yeah, I think it'll be quicker than that. I think
Mhm.
it might. We might even be here now. But yeah, it's an interesting just to have a look at that.
Yep.
Oh yeah, just so that the what you have there, just to talk you through the graph there. So personal savings rate there's the thick blue line. Now you can see it spiked right around COVID time. The personal savings rate. So that the dotted line is sort of this is what the savings rate was pre the pandemic, and if you just had extrapolated it out, so you're
Okay.
well below that now. Um,
Mhm.
and the difference between the trend and where the
Okay.
personal savings are now, you can see that that's running a pretty strong deficit there. Those negative red bars over there
Hmm.
at the end. So I think there was a headline out this week that Americans had run up $1 trillion in credit card debt. And again, the headlines come out because $1 trillion
Big number.
is a big number. What does that actually mean? But yeah, I mean, people are putting more on their credit cards because they have actually run through the savings of that period.
Yep. Yeah,
Yeah,
I see different numbers where they say it's back to pre-COVID levels, so it's not as bad as what this
yeah.
indicates, but um,
Well, you
obviously
see
people.
you see the line there, the thick blue line. I mean, it hasn't. It's not like it's turning down. It's
No,
just lower than it used to
yeah,
be.
okay.
So yeah, it's not doom and gloom, but
Hmm.
yeah, things are stretched a little bit, but we shall see.
But you can
I'm
see it can
again,
go for a long period of being stretched. Look at that.
yeah,
That like, so
yeah, yeah,
it could go for a few years like that.
yep. So what do we got this week? You're looking over at Asia again, Tim. You're obsessed with Asia.
Yeah, yeah. Well, everybody hates it, and we've both got a little bit of history in this area. Like, we both thought ASX in Australia was too expensive and
Yep.
too cheap to buy it, and we could never buy it. So I'm thinking, okay, well, no one likes China at the moment,
Mm-hmm.
so surely we'll have a quick look there. And the one in Hong Kong is basically they do their stocks, and they've got a few thousand stocks on there, and they do the futures, and they also own the London Metal Exchange, which is a pretty big trading desk. And they've got a monopoly position,
Yep.
obviously, in the stocks, and the Hong Kong government owns a slice of it, and they sit on the board. So I can't see that actually changing. A lot of Chinese companies like to list in Hong Kong so they can access international capital.
Yep.
I don't see that changing, and it's actually the fourth largest exchange in the world. It has compounded at 2,500% since IPO in 2000, compared to 215% for the S&P. It's down 12% over the last 12 months. If we look at the fundamentals, we can see these shares aren't going anywhere, so they're not buying back or diluting. PE is high, but it is quality. Return on invested capital is, high, and over a long period of time, it's been consistent. The margins are just insane, and that's only possible with a government monopoly. Like, you're never going to see a normal business with those sort of margins. The dividend is okay, but extremely high payout ratio.
Yep.
Interest coverage is great. If we flip over to the balance sheet, you'll see they have a heap of cash, negative 274 billion in debt. Free cash flow, it's taken a hit the last couple of years, but it's back to 2019 levels. Everyone hates China, and Hong Kong. We've got all that. We don't know how it's going to be in a couple of years, but the payout ratio is clearly way too high. In the past,
what are they doing with all this cash? I mean, other than paying it, they're not
dividends.
Not trying to buy any other exchanges or anything?
Well, in the past, they were looking to buy in the London Stock Exchange, which I think would be a great capital allocation decision if they could get it past, certain government bodies. And I think that would be a way better capital decision than paying dividends. They're trying to slow down, and obviously there's no IPOs or SPACs or anything like that where they can make more money. And I think maybe if it dropped 30% to a PE of 25, it would be interesting. But I want to be greedy. Maybe a PE of 18 would be something. Would be more in my range, just because you got that extra risk. You're taking on Hong Kong. Why go dabble there when you can dabble in the US? And I need a reason to go dabble over here. It's not really that nice. Got communists that basically going to be running the show in a couple of years, and you don't know what they're going to do. They don't care about you as a shareholder, so a fairly big discount. So it is a great business, and if you go back and look at those return on invested capitals, it's just insane, and the margins are just. I just wish they would purchase something decent. Look at the London.
You can't imagine that China would kill the goose that lays the golden egg. I mean, as you said, this is access to a deeper capital markets, isn't it, for Chinese listed companies?
Yep.
They wouldn't want to shoot themselves in the foot, I wouldn't think.
Yeah, you say that, but they just, if they decide they want to go against you, they go pretty hard. So that's the opportunity, I guess. If you can hold your nose and buy something like that, but everyone goes, when could you buy the ASX? Never. And you look at the price.
Well, yeah, maybe around the turn of the century. This is back when I covered it. It probably was a good buy, and but it wasn't obvious at the time why. So back in 2000, if you remember, Australia, I don't know if you remember these headlines, but Australia was touted as we had the highest rate of direct investment in stocks. Something like 50% of Australians had a direct ownership in not through a managed fund or something. So a lot of people, if you remember, they bought those share packs. Do you remember those? And it would have like Commonwealth Bank, BHP. Just remember these? Yeah, I think my mother actually bought
blue chip stuff. Yeah.
Yeah, blue chip. And so a lot of people had that, and of course, at the same time, you had online trading was starting up. E-trade it was the big thing in Australia, which ended up, the value of E-trade ended up being written down by about 90%. But anyway, so you had all this trading going on. People can trade from home. Remember that everyone's going to be millionaires from trading stocks at home. But then that all collapsed in the .com era, right? And so we'd hit sort of peak direct investment in stocks. We'd hit sort of peak trading, and we thought it wasn't obvious where the catalyst was going to come from because this bubble had just burst. And it's like, well, people aren't going to be sitting at home trading stocks now because they just lost a shitload of money. But of course, what that ended up being was just a little blip on the way to,
they own the rails. They own the rails.
Yeah.
And you want to do anything? Yeah.
I went down to the ASX, interviewed the CFO at the time twice, and tried to, and I would ask him questions like, well, where's all this extra trading activity going to come from? And he wouldn't say any. He wasn't forecasting anything. He said, well, we don't know. Maybe. I said, what about derivative products, warrants, all these other new products? And he's like, oh, maybe, but we don't really make much from that. And so he just gave me nothing. He gave me he was not promoting his company. He was just saying, yeah, we're just going to keep doing what we're doing and see what happens. So I could not come up with a catalyst for why this thing would go up. But, it was a good investment at the time.
Yeah, a steady winner stays a steady winner, And we keep forgetting that. We go, we want to look for the next greatest thing and pick the winners that are winning already, mate. Like, don't try and do these hard things. Pick a winner that's already winning. So at some point here, this might, if China doesn't do stimulus, no one in China or Hong Kong is going to be wanting to be looking at the share market, and no companies will be listing. But if they do a heap of stimulus, which is probably the more likely path, this is probably going to skyrocket again. But it's just one of those things, no one likes China, no one likes Hong Kong at the moment, and everyone's going, I wish we could buy these monopolistic type companies. Well, this is when you should be looking at them. You should understand them, and then you get an opportunity. You should. Yeah.
And then emerging markets have just performed awful. I think they've had a decade of basically zero returns or something like that.
Yeah.
So that maybe you should be a little bit more greedy when others are fearful.
Yeah. So me, I'm too greedy. That's the problem with me. But I think you need to be, especially if you're going into EM. You've got to be super, super greedy, and that means you need a huge margin of safety, or you get hammered. Even Terry Smith understands that now. So best in the world. Can't beat that sort of understanding. So I don't know. Just kind of thought I'd have another look at. I'm still interested in China, but everybody knows all the other markets. Everything in the US. So I'm trying to increase my scope a little bit. That's all.
Well, it just seems boring right now because you're just looking like, I can't pay that for that. I can't pay up for that. I can't pay up for that. Jesus, it's like, whoop, I'm not giving into FOMO.
Yep. Okay, well, that's about it.
All right. That's it for this week, people. Tim has brought you another one from Hong Kong. So take a look at that, and we will see you next time.